Good afternoon, everyone. Thank you for joining us on this Thursday for the October edition of our Tarrant Financial Partner webinar series. Today, our partners from Federated Hermes will be giving us additional insight into the Strategic Value Dividend Fund and separately managed accounts. If a question comes to mind during the presentation, please feel free to just drop that into the chat and we will be sure to address it at the end. With that, I turn it over to Mike.
Charlie, thank you very much. Welcome, everybody. Thank you for joining us here at the lunch hour on a beautiful fall afternoon here in the metropolitan Atlanta area. Hope you guys are enjoying the beautiful autumn weather wherever you may be located. As Charlie mentioned, the Federated Strategic Value Dividend Strategy is an integral part of our Alpha mutual fund and ETF portfolios, and also in certain situations, the separately managed stock account as well is utilized. We'll be reviewing both of those today with an overview of the strategies. And joining us as our guest presenters today are Matt Ryan, not the former Atlanta Falcon quarterback, but better. He is Senior Vice President and Regional Consultant with Federated here in the metropolitan Atlanta area. He attended the University of Dayton, where he actually played football and graduated with a degree in accounting and an MBA with the concentration in finance. He began his career with Federated way back in 2004 at the headquarters in Pittsburgh, then moved to Atlanta in 2006 to serve as regional consultant and senior vice president, working with broker-dealers and registered investment advisors such as ourselves. He resides in Buckhead with his wife, Katie, and two active teenage sons who attend the Mayor's School. Also joining us is Nick Kimmerer, vice president of managed accounts, who joined Federated also way back in 2004, having worked in customer service and marketing. He has been in external support since 2008, currently serving as managed account specialist, focusing on Federated separately managed account offerings and discussing industry and economic trends with representatives, advisors, and their clients here in the southeastern United States. He was awarded the Chairman's Club designation in 2015 for exceptional client service, has been a great supporter of our practice, and is a graduate of the Westminster College with the BS in International Business. Currently maintains a Series 7 and 66 securities license, so hats off to you on that, because that's a big deal, and resides in Wellington, Florida with his wife and 4 children, so he's a busy man as well. So with that, we're going to turn it over to Matt and Nick today for a Federated update. Thank you, gentlemen.
Great. Thank you, Mike and Charlie. Appreciate it. Appreciate the invitation, and it's good to be with you all. As Mike said, my name is Matt Ryan. I am, they call me Matt Ryan, the original, because there's always the, are you the real Matt Ryan, or is that the real Matt Ryan? But so back when he was drafted in 2008, after I had lived in Atlanta a couple of years, that definitely became a thing. And so the original Matt Ryan was born in 2008. So it's been a bumpy ride, but you know, we see him every now and again. I think he's back in town. So anyway, so moving forward, today, what we thought we would do is talk a little bit about Federated and the strategic value dividend strategy. And where I thought I would start is kind of who are we, a little bit about what do we think, and then lastly, what do we recommend? So I'm going to start and talk about Federated as a firm and a little bit about who we are and what we think, and then as we get into what we recommend, I'm going to turn it over to Nick to dive more deeply into the strategic value strategy. So Federated Investors was born in 1955. 3 high school friends got together and started selling mutual funds door to door. So it's a humble roots type of a story. Our headquarters has always been in Pittsburgh and continues to be there today. I'll show you a slide here of what the footprint looks like now, but all beginning back in 1955 in Pittsburgh. We currently have over $700 billion, as you can see, in assets under management spread across the globe, and many strategies on both fixed income, equity, and liquidity. A big part of what Federated does is in the liquidity management division. So about half of our assets are in that kind of money market space, which I'll go back to in a minute when we talk about kind of what we're thinking. I think with the Fed and interest rates, everybody kind of wants to know what our thoughts are there, given our size in that space. So Federated Like I said, 1955, started in Pittsburgh. I also started in Pittsburgh in 2004, and rightly thereafter, or rightly there before, Nick Cameron, my co-host here, was starting at Federated at the same time. We took different paths, and he went through Boston down to Florida, and I came down to Atlanta. It's great to be here with him today to discuss the strategic value strategy. When I talk about Federated in regards to the different asset classes that we hold, so there's a picture there for you about the money market assets being nearly half the firm, and then you get into the other divisions: fixed income, alternatives, and equity. Today we're going to focus in on that equity piece of the pie there in our strategic value strategy, which in total is $40 billion. So definitely a very large part of Federated and a core competency of what we do at the firm. So it's nearly half of our assets in the equities, in the equity piece. So you think of the strategy that you all hold with us in the strategic value dividend strategy is a concentrated portfolio of 35 dividend paying stocks. And so that falls within our equity sleeve, and you'll see there under that $80 billion. That's a little bit about who Federated is, just from a very high level. At this point, I'm going to dive just a couple comments on, what our outlook is in regards to the economy and the markets. That's with the Federal Reserve and interest rates kind of on the headlines every day. And are we going to be are we in a recession? Are we going into a recession? And kind of what Federated is thinking. As you'll hear, most firms, we are definitely on the conservative side of things in regards to what we think is going on in the economy. So we've stayed very defensive this year, both across our fixed income and equity portfolios. So going back, if I think to when we put out our outlook for this year, back in January and February, both of our equity and fixed income folks were expecting us to be in a recession, and probably expecting us to be in a recession by now. One of the recent pieces that our economists put out is, it's better to be early than late when it comes to having a defensive position. So he's explaining the reasons as to why we are okay with being defensive early in regards to the economy. So as the Fed started 18 months ago, increasing interest rates off of zero, and if you think of the last 11 years, their interest rates have been zero 8 out of those 11 years. And once the Fed started really raising interest rates, it went fast and it went high quick. So today we sit at 5.25 in regards to Fed funds, and that is can be very difficult for corporate earnings, for financial institutions and whatnot in regards to the economic economic backdrop of how the economy is working. So once we're seeing the Fed doing that type of movements in interest rates, it's great for the money market funds. It's great for cash. We're able to pay out an income stream, and everyone is very excited to be able to have an income stream off of their cash. But that's kind of one of those things that will only last for so long. So once we see that we're getting to the end of the Fed rate hiking cycle, and that's kind of one of the things that I get asked about a lot, is what's Federated's position on when will the Fed stop raising rates? In our last meeting, we're about 50-50 split of whether we're going to have one more hike or no more hikes. So really what that tells me is we're pretty much at the end of the interest rate hiking cycle as we see it now. And we'll get into what they call the Fed pause. And that's a period of time where the Fed is neither hiking nor cutting, and they're letting those hikes get into the system. But that is a period of time of where we could see quite a bit of volatility, and we're kind of getting towards the end of a cycle in respects to growth. And we want to be much more defensive in both our equity and our fixed income portfolios. So we're suggesting that folks lean towards the value side on the equity part of the portfolio, and in fixed income, owning very high quality fixed income and moving out the curve a little bit. So maybe getting out of some of those cash portfolios and moving out the curve, what they call extending duration, as we see the Fed, positioning for their next moves, which could be a year out in regards to cutting rates. If you look back over the last 2 years in aggregate, everyone knows this year growth has really outperformed the market. And we've seen 5 or 7 stocks return on aggregate of nearly 90% this year. But if you look back and try to think about what's happened over the last 2 years, because it's really been quite the roller coaster. Last year, dividend paying stocks were up 6 or 8%, when those Magnificent Seven stocks were down 45%. And then you fast forward to today and you have almost the exact reversal in regards to what has happened in the marketplace. So what does that tell us? It tells us that you've seen this huge run in growth this year after a major underperformance last year, but the total return is virtually flat. And the same can be said for both in the dividend paying stocks as well. We, given that, would much rather have a smoother ride in regards to the total to the price action, but provide an income stream along the way. And as we're heading into a period of time where we have these higher interest rates for longer, we would much rather be in a dividend focused portfolio, provide that 5% stream of income and limit that downside volatility. So that kind of leads my next part of the presentation, where I'm going to turn it over to Nick to kind of dive into, now that we're recommending dividends and we're recommending you be more value tilted in the equity part of your portfolio, what would you use and how would you implement that? And at Federated, we use our strategic value dividend, SMA, and fund. And I'm going to let Nick kind of give you the ins and outs of what that strategy does on a day-to-day basis. So Nick, I'll turn it over to you now.
Matt, thank you very much. Charlie, Mike, thank you for the opportunity to be here as well. And thank you to all who are in attendance. It really is a pleasure to be part of this morning. Again, by way of introduction, my name is Nick Kemmer. I'm the Managed Account Specialist for Federated Hermes. And I personally represent all of Florida, all of Georgia. So that is the territory that I focus on. In regards to what I wanted to discuss with us today, and Matt kind of teed up for us, is our strategic value dividend suite of products. And we're available both in a separately managed account and a mutual fund. And for those of you that aren't familiar, the main difference there is with the separately managed account, you're going to be a shareholder in each one of the actual positions that we own. So you will see the stocks that are in the portfolio. And then there's the mutual fund version as well that I believe many are familiar with. In regards to our strategy, there's 3 objectives that we seek to deliver for our clients. First and foremost, it's to deliver a high income stream. And we target a dividend yield of approximately 4 to 4.5% for our clients. The yield for new money today is sitting at 5.39%. And we've actually been running this portfolio for the last 22 years. Our inception date was September 1st of 2001. And we've had an average dividend yield of approximately 5% over that 22-year time period. I point that out because I think it's important to note that we've consistently been in that high yielding position for our clients. It's not as though 18 months ago or 2 years ago, Federated as a firm decided now's the time to ramp up on dividend paying stocks. And as a result of it, you found a higher yield there. We've consistently been in that ballgame. The second objective to what we do is we don't only screen for companies that pay a dividend, but we look for companies that have the ability and inclination to grow that dividend by another 5 to 7%. And we would equate that dividend growth to capital appreciation. And we say that with conviction because we know that there's a 91% correlation with companies that pay and grow their dividend and total return. So if we can identify companies that not only pay the dividend, but grow the dividend, you're 91% of the way to total return, relying only on 9% of, will the markets be trading higher or lower next week, next month, next year? The last objective that we seek for our clients is low correlation or downside protection. Beta on this portfolio is roughly a 0.7. And what beta measures is the amount of risk that you're willing to take for each unit of return. So a beta of 1 means you're taking as much risk as the overall market. A beta greater than 1 is that you're taking significantly more risk, which is not necessarily a bad thing. And a beta less than 1 is that you're taking less risk than the overall market. So what we say in short is if we can identify a portfolio and deliver it for our clients that's going to seek a high dividend income, again, 4 to 5%, today we're at 5.4, dividend growth to the tune of 5 to 7%, and roughly 2/3 the risk of the market, will take that all day long. So if you take a look at slide 6 there, if we can go back one more, Matt, what you're looking at here is the investment team. And I think it's very important to note that you've got some highly experienced individuals that are running your money on behalf of you. Daniel Paris, Debbie Bickerstaff, Jared Hoff, and Michael Tucker are your lead portfolio managers. They all have roughly 24 years of average investment history in the portfolio. Within there as well, you've got 7 analysts, and you can see the tenure that we've got there. The point being with all of this is that we've got tenure and the bench is deep. You've got a lot of seasoned individuals that are representing the portfolio and going out there and kicking the tires of these companies for you as the end investor. If you flip over then to page 7, that's going to focus on what I just talked about, the correlation of companies that have the dividend yield and dividend growth and the correlation there between the two. In regards to the portfolio itself, as Matt mentioned, we own 35 positions in this strategy, and they're all common stocks. There's no preferreds, no convertibles, no MLPs. This is plain vanilla, back to basic investing for our clients. The dividends on the portfolio as well are largely qualified. And what I mean by that is you're going to get a tax advantage treatment of 15 or 20% as opposed to ordinary income. And there's also a 3.8% Obama tax that is on top of those that we can't get around. But the point being is that depending on your household income, you're going to be taxed either 18.8 or 23.8 on the dividends themselves. In regards to dividend growth, in the portfolio of 35 stocks, in the trailing 12 months, 32 of the companies within the portfolio raised their dividends for a total of 33 increases overall. So CIBC, which is one of the holdings, actually raised its dividend twice for us. And I think that gives strength to what the portfolio is seeking to do and the portfolio management team, that we're not only identifying companies that pay, but more importantly, grow their dividends. Historically, the dividend average going back over inception has been 27 dividend increases each year, and on average 1 dividend cut. So we are human. There are times that we will miss a dividend cut. Now, largely speaking, when the company cuts its dividend, immediately we're on top of that. Why did they cut the dividend? What did they cut the dividend to? And what is the focus moving forward in regards to dividend yield and dividend growth? What I will tell you is that approximately 90% of the time, when a company cuts its dividend, they're removed from the portfolio. So, we are doing our due diligence on each one of the companies there as well for our clients. Of the 35 stocks in the portfolio, I think what is great to note, especially in this environment of where do we go from here? Again, markets last year down 18%. Year to date, they're up 10%. They were up as much as 20%. We've got Fed. We've got an election year coming up. As Matt pointed out, historically, whenever the Fed pauses, the markets rally an additional 19.47%. So where do we go from here? Because while some of the indication points would say that we're a little bit higher for longer here, and that the markets have got some run left in them, it doesn't feel good. It doesn't feel right. When you look at the portfolio and what we own, the beauty of this strategy is the name recognition. In this portfolio, we own companies like Best Buy, Coca-Cola, which I think many of you are probably familiar with out of the Atlanta area. And even if you're not, I'm sure we've all heard of Coca-Cola before. Conagra, Kimberly-Clark, Philip Morris, Unilever, Chevron, PNC Bank. AbbVie, Amgen, Gilead, Pfizer, UPS. And so I point this out because these are a lot of the tried and true companies. They're multinational corporations that have a global footprint. In regards to the portfolio itself, at all times, you will be owning 20 to 30% ex-US in the portfolio. So there is that global footprint as well in regards to where these companies are domiciled. But they're companies like Unilever and Sanofi, CIBC, which is Canadian Imperial Bank of Commerce. So they're big global companies that, again, you most likely are familiar with as well. In regards to portfolio construction, when we're putting together the strategy for you, what we take a look at in our investment criteria for each company is that your stock has to have a dividend of 3% and greater. We need market capitalization of $2 billion and higher, and the ability and inclination to grow that dividend by another 5 to 7%, as I talked about there. So what we will do is we'll take a company like Coca-Cola that's only yielding you 3% and change, but historically has raised its dividend by 8 to 9%. And we'll match that up with some of our higher yielding stocks that are yielding you 6, 7%, but we would expect them to grow their dividend in the 1 to 3 range. When you take a 3 yield and an 8 grow and match it up with a 6 yield and a 3 grow, it allows you to hit that overall objective, which again is 4.5 yield, 5 to 7% growth, without taking on significant risk. We're not putting all of our eggs in one basket saying you got to have a dividend yield of 4.5% or 5 to be considered for this strategy. So when we're comprising the portfolio, that's sort of what we're taking a look for as well for our clients. Ways that the strategy are utilized. Number one is kind of as an income-focused portfolio. Again, notably higher yield. If you take a look at the S&P, the dividend yield on the S&P is approximately 1.7%. We're yielding 5 and change. So for clients that are seeking income and growth, this is a portfolio that resonates with the clients. Second way that the strategy is being utilized is just as a value sleeve in regards to your portfolio. And if you're willing to take risk for your return, let's pair that up with a more conservative strategy and a conservative sleeve as opposed to that growth portfolio and shooting for the higher returns. We're more of that 8 to 10% total return strategy that we're looking to deliver for you as the client. Last way that I would mention that we utilize this portfolio or see it being utilized, and this is a way that personally my wife and I use the strategy. And so for those of you that are focused on real estate, real estate obviously has had a significant run up. Rental properties, if you would, in the most simplistic terms, think of this portfolio as a rental property. And the reason I say that is, what's the sign of a good rental? Well, it's the ability to collect that income on a monthly basis and to raise the rent on your tenants year in and year out. And if you're able to do that, that rental property should be worth more over time. Now, again, Zillow might come to you and say, hey, that property you purchased for $250 is now worth $200. It may be worth $350, but we're in that investment to deliver a high and rising income stream, and we're not going to sell a portfolio just because it's down or because it's up significantly. It's doing what it's been initiated to deliver for our clients. Last way, and I apologize, I said last way on the one before that, but the last way that we see this portfolio being utilized is for our institutional advisors as well. So for any of you that sit on boards that have the RFP and the focus there is that you've got typically a 4 to 5% payout ratio that is required for the institutional relationships there. This is a portfolio that can accommodate that spending policy without digging into principal. So again, the beauty of this portfolio is the simplicity. High dividends, rising dividends, low downside protection. With the separately managed account, you've got complete transparency. With the mutual fund, we can share the holdings for you on a month-end basis. But that really is what we do. what we don't do and what you'll find that we don't own are the FANG stocks, if you will, as Matt hit on, or the Magnificent Seven or the Crazy Eight, kind of whatever grouping you've heard of those stocks, the Facebook, the Apple, the Amazon, the Netflix, the Google, throw in NVIDIA and Tesla, and that kind of gets you to your seven. And it's not that those companies are bad. It's not that we don't think those companies have legs to continue running. It's not that we don't think those companies have potential, but we have to stick to our knitting and what it is that we do. And again, with the dividend yield threshold of 3% and greater, as much as we may like those stocks or dislike those stocks, we can't invest in them. And I think that's very important to keep in mind as well, is you won't find this portfolio deviating from what it is that we're designed to do. So kind of with that, I think I'll come up for air and be happy to address anything that you may have in regards to the portfolio itself.
Yeah, Nick, thank you very much. Matt, thank you very much for the update as well. So just everyone, if you have some questions for me or Nick or Matt or Charlie, feel free to drop those in the chat, or you can, we're kind of a home crowd here. You can unmute your mic as well. While that's in process, Nick, one point that really stood out here in y'all's commentary was just remembering, if the dividend yield on a company, say like Coca-Cola, remains flat at 3%, but they're still increasing their dividend, well, that means their price is increasing as well. So I think that's just a key point to remember, as you're looking over your portfolio, y'all, is just that, that if you're seeing the dividend yield, the number, percentage yield staying flat, but their company's increasing their dividends, well, that means their price is going up as well. So that's a positive takeaway, I think, Nick, from your talk that I heard about. I will ask one question that I know we're getting from other folks. Obviously 2022 was a good year in the portfolio when deep value and high dividend stocks were in favor. Our strategy, or your strategy, was up nearly 6 to 8%, depending on which date you're looking at. And of course, this year's been more of a challenge as we've seen that rotation. So can you kind of speak to your take on some of the reasons behind that shift and what's Federated done to take advantage of the current market and maybe to protect the portfolio at the same time?
Sure. I think what's interesting to note in regards to the portfolio, and you're spot on. Last year, markets down 18%, nothing felt good. We were up 6%. And I don't say, well, because we were up 6%, throw all of your money to Federated. We'd like that, but that's not realistic. So, what has been driving the market, as we talked about, it's been those handful of individual stocks. But I think what I find most interesting is we actually broke down the S&P 500 in regards to the stock quality ratings, beta, yield, and market capitalization. And a couple of the things that I'll hit on is, number one, beta. If for companies that have a beta of approximately 1.3 to 2.6, so those high risk beta stocks, which again, nothing wrong with them, but just knowing what it is that you've got, those stocks on average year to date have been up 51.73%. The companies that have low beta, 0 to 0.7, year to date are actually down 2.11%. So you're not being rewarded for that conservative approach this year. Now, again, last year, those numbers were flipped. From a yield perspective, companies that pay no dividend at all, on average, are up 42.05%. And companies that have a dividend yield of 3% and greater are up approximately 1.84. What we know is that this is not the historical norm. Over time, again, as we focus on companies that pay and grow their dividend, that's the propellant to capital appreciation. What I will mention as well, though, is regardless, markets up, down, sideways, flat, the dividend is paid off of the number of shares, not the value of shares. So again, our focus being on what's the ability and inclination to continue to pay and grow, that's what's going to drive total return over time for our clients. The other
That's
thing that I'd mention too, real
Mhm.
quickly, if I could, when you break down the S&P as well, those 5 to 7 stocks make up approximately 28% of the S&P at this time. And so you've got a handful of stocks that make up a majority of the market or a quarter of the S&P that we can't own, that are largely driven by the technology space. So I think it's important to note as well, when you've got a handful of stocks that represent so much of it, the returns of the broad market are going to be driven by how those handful of stocks perform. But we're able to find value, in our opinion, in the other 495 stocks that are out there.
Right. Yeah, I think Nick, when we were talking the other day, you guys had mentioned, when you look at the S&P 500, up, a little bit this year. I think about 8%, somewhere in that neighborhood. You take out those magnificent seven, so to speak, the other 493 companies are up, what, 2%, depending on the day you look at it. So there's definitely an undercurrent of some type of a correction or a stalling, so to speak, taking place that we should be aware of. So that's a really good point. This also reminds me as well, when you have a challenging year like this year, where it looks like nothing's happening in a portfolio, I think it's interesting to note, you mentioned 32 dividend increases within 12 months. There's just want to remind everybody, whether it's this strategy or a different strategy, when we have active managers in the portfolio, it's because they're doing stuff behind the scenes to help improve the portfolio or take advantage of challenging opportunities. So just when you see prices kind of flat to down, don't think nothing's happening within that sleeve. There's something happening behind the scenes. And if you ever have questions on what that is, feel free to let us know, because we can update you on what the managers are doing. But Nick, to your point, and Matt, to your point there, let's talk for a minute about circling back to the Fed and, kind of the position that we may be near a pause in rates, and then hopefully maybe see a little bit of downward movement in rates at some point. If that were to take place, if the Fed begins to trim rates, how do you expect that to affect the portfolio?
So, like I had mentioned, we feel like we're in about the 8th or 9th inning in regards to the Fed, interest rate cycle this go around. So it's we're starting to lean towards that the Fed is done raising rates in regards to Fed funds, and that as much as the Fed would like to keep rates higher for longer, sometimes that's not always the case. They have to follow what they call their summary of economic projections, and really watch month to month what's going on with the economy, because when you do raise rates as quickly as they have and up as high as they've done this time, you can really start to see some cracks in the economy, right? So, and that kind of, if you rewind back to the spring, we saw a little bit of a hiccup in regards to regional banks, and you've seen some other issues in the economy. But what has really held tight is the labor market. So that's kind of one of the real keys to this cycle going forward, is keep a close eye on what is going on with the labor market. And the Fed won't overtly come out and say it, but a big part of what they need is unemployment to go up, because that is essentially what's going to crack the back of inflation, and specifically wage inflation, which is highly correlated to what's happening in the CPI month to month. So that being said, we feel like we're near the end. We, as a firm, do believe in the next 6 to 9 months that the U.S. economy will slide into a recession, because the Fed has never gone through an interest rate cycle like this, and where we have not seen a recession come afterwards. If there is, you hear about soft landing, we feel like that's a bit of a unicorn, in the sense of, will they be able to pull it off? Because you've got that dance of, we're going to raise rates, but we don't want to put the market into a recession, or put the economy into a recession. But we feel like that's a bit of a mirage, and that there will be, a recession here in the next year. And as that starts to happen, the Fed will be forced into a situation that they will have to start cutting rates, right? Because you can't keep interest rates high while the economy is falling into a recession, or you could just have a lot more issues in regards to your currency and whatnot. So all that said, the timing of it is very difficult and almost impossible to position, and that's where we find, okay, what we're invested in, these stable dividend paying stocks, as you like, I'll pull up the list again of the current portfolio. These are the companies that we feel can weather the storm of the coming recession. These are the companies that aren't going to change their dividend policy because GDP growth goes from 3 to 0 or 2 to -1, or at the margin, GDP growth and interest rates are not affecting these large companies as much as they would, say, the technology space as a flip side. So we aren't necessarily going, like Nick said, change what we're holding on a month-to-month or quarterly basis, but what we're doing is consistently investing in companies that pay and raise their income regardless of what is happening in the U.S. economy, if that helps.
We have a question, a very good question. Interest rates have been historically low over the past 20 years or so. Since investors are able to get a 4 or 5% safe-ish return in bonds, CDs, government bonds, without being in stocks, do you think that may cause slower growth for the stock market because of that higher yield and safer investments?
I can start and I can let Nick. Yeah, that is we see that a lot, obviously, at Federated, with the amount of folks that are invested in our money market funds that are yielding anywhere from 5.25 to 5.75. So that having that cash and that income stream is very comfortable, and it's something that we've not been able to have much in the last 20 years in regards to the investment community. So there is a lot of cash on the sidelines in that regard. So there's the aspect of, does that hamper or does it help the equity market in regards to flows? There is the opinion that once we reach this Fed terminal rate and the investment community is convinced that the Fed will not continue to raise rates, and even well before they have to make a cut, you are going to start to see some funds flow out of cash and into longer duration bonds and dividend type paying stocks, kind of the two next levels of risk outside of cash. Because if you just look back in history, the Fed pause that we've been talking about, as much as they, like I said, to really dampen inflation, would like to keep rates high, it typically only lasts about 4 months before they end up where the economy is not looking as bright as they would like, and they have to start making some cuts. So that 5% you're getting in cash may not last as long as everybody wants it to last. And the dividend stream that you can get in something like this strategic value dividend, where it's at 5.25, can move a little bit higher as prices move around. But the ability to get 5% from a common stock portfolio, or let alone as you can move out the risk. We see a lot of folks using like a total return bond fund type strategy where you've got 4 to 5% of income from investment grade corporate bonds and U.S. Treasuries, but as if interest rates go down, those bond funds could be up 15-20% over the next year as prices move in reverse. Because it's been, we talk about the last 2 years and where the dividend stocks did well, then the growth stocks did well. You look at the bond market the last 2 years, it's the worst it's ever been, and you're talking about consecutive years down 20, down 5. Like, we've never seen anything like it. So in that regard, there is some value to be had buying some longer duration bonds. So kind of a long-winded answer to just, we're in an inflection point, and we do see some opportunities outside of cash albeit cash is very nice and the income stream
Right.
is. So,
And we're coming up on our 8:40 time limit here. So if everybody's okay hanging on for about another 3 minutes, maybe we can wrap up with a corollary to that question. Is let's assume for a moment that rates actually don't really come down, and the Fed's not really able to do that, and rates stay around that 4 to 5% range. What impact do you think that might have on equities and bonds as investors are able to maybe move money out of risk assets, into cash and get that 4 to 5% yield?
so for rates to continue to stay high and be in the, continue to get cash payments in the 4 to 5% range, it would mean that the Fed pulled off the soft landing, right? So it would be that we don't go into a recession and the labor market stays tight and the economy keeps growing and GDP growth keeps going. That would be green light for risk assets. And that is a bit of actually one of our kind of, we put probabilities on what we think might be the outcome over the next 6 to 9 months in regards to stock markets and bond markets. And it's a lower probability, but that is definitely a chance of things saying, well, the Fed pulls off the soft landing, GDP growth stays good, the labor market stays strong, interest rates do stay high, but it doesn't hurt the earnings of corporate America quite as bad as one would think. And that's a green light for risk assets. And in that scenario, we think the S&P 500 goes to 5,000.
Okay. Yeah. That would make sense because some good things would have to happen for that to be the case. But yeah. And maybe at that point too, if they do engineer the soft landing, investors feel more confident to put money to work in risk type assets, and we get back to some common sense of midterm, short-term, and long-term buckets, with the short-term bucket actually having a decent yield on it.
Right. Yeah, no, it's a great scenario. Exactly.
Yeah, absolutely. Well, guys, we really appreciate your time this morning. Thank you, everyone, for being on board this early on a beautiful fall day here in the Metro Atlanta area. We hope everyone enjoys your afternoon. If you didn't get enough info out of the morning session, feel free to jump back on 12 o'clock. We'll do it again. Thanks, everybody. Have a great day.